Welcome back to the deep dive. We're looking at what feels like a classic Jekyll and Hyde situation today.
That's a good way to put it.
I mean, if you were holding Roku stock in 2025, you were probably feeling pretty brilliant. The stock was up 46%.
Yeah, completely crushing the market average. It was a huge winner.
But if you're holding it now, in early 2026,
You're probably sweating a little bit.
more than a little. Since the calendar flipped to 2026, the stock has shed, what, 18%?
18%. It's a massive sentiment shift.
In just under 6 weeks. And that brings us to the immediate stakes. It is Tuesday, February 10th. Roku reports its Q4 earnings this Thursday after the bell.
And the pressure is just immense. They aren't just reporting numbers. They have to justify why that narrative turns so sour so quickly.
So our mission today is to figure out if Roku can snap this losing streak. We're going to unpack the three specific hurdles, the three things they really need to clear on Thursday.
Okay.
But first, can you just quickly set the table on the macro environment? Because it feels schizophrenic.
It really is. On one hand, you have the S&P hitting all-time highs. UBS is out there calling for 7,500. So the market itself is euphoric.
Right.
But then you have these heavy hitters, people like Bill Gates warning about dead ends in tech.
So it's confusing.
It's the worst kind of backdrop for a company like Roku. It's a growth stock trying to prove it's a mature business. And in this environment, investors are they're looking for any excuse to sell.
They are looking for cracks in the armor. So let's look at the first potential crack, the hard numbers.
That's the fundamentals.
The headline expectation is revenue. Roku guided for a record $1.35 billion. On paper, a record sounds good. So why is the market so nervous?
Because in this case, that word record is doing a lot of heavy lifting. Yes, hitting that number means 12% year-over-year growth.
Okay.
And it extends their streak of double-digit gains to 10 quarters, which is impressive. But, and this is really the key insight, if they land exactly on that guidance, it will be their weakest revenue growth rate since the spring of 2023.
So the car's still moving forward, but the acceleration is dropping off.
Precisely. You said it. Momentum is a derivative of speed, and the speed is slowing down. And when you're priced for growth, deceleration is almost always treated as a failure, even if the absolute numbers are still going up.
Okay, however, the counter-argument to that, the other side of the coin, is this big pivot to profitability.
Right.
Roku spent years, famously just burning cash to acquire users. That era seems to be over. They're guiding for $40 million in profit for the quarter.
Which, it sounds pretty modest for a billion-dollar company. It's only a 3% net margin.
A tiny margin.
It is. But the context is everything here. If they hit that $40 million, it's their biggest profit since that pandemic peak back in summer 2021. And more importantly, it's the third straight quarter in the black.
And that's the maturity signal investors have been waiting for, right?
Right.
It's no longer just growth at all costs.
Exactly. And the other efficiency metrics, they back that up. They're targeting an adjusted EBITDA of $145 million. That is an 87% improvement year over year. They are squeezing significantly more value out of every single dollar they bring in.
So the financial hurdle is beat the revenue slowdown narrative and prove this newfound profitability is sticky. But there's a trapdoor here, isn't there? We are in February.
The guidance trap, of course.
Yeah.
Roku hasn't issued a forecast for the full year 2026 yet.
So Thursday isn't just about Q4, it's a beat and raise requirement.
It's absolutely mandatory. They can put up a perfect Q4, but if they come out and say, hey, 2026 looks a little soft, that 18% drop we saw in January, it's going to get a lot deeper.
So they have to beat Q4 and promise the 2026 that exceeds what analysts modeled, 3 months ago?
That's the bar. It's a high one.
Okay, let's move to the second hurdle, which fundamentally explains how they're even planning to hit those targets. We need to talk about the Amazon factor and the big shift in their ad tech.
Yeah, this was the main driver of the stock price in 2025. This was the big story. Roku partnered with Amazon to use Amazon's ad tech stack to monetize the Roku platform.
And that makes total sense strategically. Amazon has all the shopper data, Roku has the viewers. It's a perfect match.
It should be.
But this partnership has coincided with a really frustrating trend for anyone trying to analyze the company. It feels like Roku has just turned the lights off on their own data.
The black box problem, it's becoming a real issue for analysts.
What do you mean?
Well, Roku used to report active accounts and ARPU, average revenue per user. Those are the holy grail metrics for this streaming company.
Wow.
Gone. They don't even break out ad revenue separately anymore. It's all just lumped into this generic bucket called platform revenue.
It honestly feels like they're hiding their homework. Like, trust us, the business is great, but you can't see the details.
It forces investors to fly blind. To be fair, this is becoming the new normal for streaming services, but we did get one crucial breadcrumb in the third quarter report.
Which was the first one after the Amazon deal launched.
Exactly. And in that report, Roku claimed their video ad business grew faster than the overall U.S. digital ad market.
That is a bold claim. That implies they are stealing market share from competitors like Google or Meta.
Correct. And that is the single most important thing that investors need to see verified on Thursday. Was that Q3 bump a one-time thing, like a honeymoon phase with Amazon, or is this a sustainable trend?
Because without user counts to look at,
Right.
that narrative, we're outgrowing the market, is the only real pillar holding up the valuation.
And if that growth rate in platform revenue dips even a little, the market is going to assume the Amazon deal isn't the silver bullet they hope for.
And the stock gets punished.
Immediately.
This leads perfectly into the third hurdle, which is this kind of structural paradox in Roku's business model. We see Roku TVs everywhere. You walk into a Best Buy, they just dominate the wall.
They're ubiquitous.
But selling TVs isn't actually how they make money.
Not even close. In fact, selling TVs often loses them money.
Can you walk us through the math on that? It seems so counterintuitive.
So you have two segments. Platform revenue, that's the ads and software, that accounts for about 87% of their total revenue.
The vast majority.
But it accounts for more than 100% of their gross profit.
Wait, how is that possible? More than 100%?
Because the hardware side, the devices segment, actually drags them into the negative on a profit basis.
So the hardware is a loss leader.
Exactly. It's the cheap razor handle to sell you the expensive blades. They are perfectly willing to eat a loss on a 50-inch TV to get a subscriber who then generates high-margin ad revenue for the next 5 years.
Which brings us to what you could call the holiday quarter trap. Q4 is Christmas. People buy TVs.
Millions of them. And that creates a gross margin squeeze. If they sell too many TVs without a corresponding explosion in ad revenue in that same quarter, their overall profit margin percentage tanks.
Because the hardware loss just outweighs the ad gain, at least in the short term.
In the short term, yes.
And this specific Q4, the one they were reporting on Thursday, has an even nastier comparison problem. We have to look back at Q4 of 2024.
Ah, yes. The election quarter.
Right. In late 2024, Roku was just flooded with political ads.
Which are high volume, high price. Just pure profit for them.
It was an artificial sugar high for their margins.
It was. Now, look at Q4 2025. No election, no political ad windfall. But they still have all the heavy hardware costs from the holiday season.
So they are facing a margin crunch from selling all those TVs. But they don't have the cushion of political ads to soften the blow.
That is the danger zone. That's what people are worried about. Investors are asking, is the organic growth from this Amazon partnership strong enough on its own to fill the huge hole left by those political ads?
And if not?
If not, their margins are going to miss the target, and that whole profitability story starts to fall apart.
It really is a perfect storm of expectations. Let's just summarize. They need to hit record revenue, but do it despite slowing momentum. They need to show that this new profitability is real and sustainable, despite a lack of political ad money.
Yeah.
And they need to guide 2026 higher than 2025, which was already a great year.
It's an incredibly tightrope walk. And frankly, the market's 18% drop suggests most people think they're going to fall.
Before we wrap up, I just want to go back to that point you made about the missing metrics, the active accounts, the ARPU. You mentioned this is becoming a trend.
It is. Netflix, they stopped reporting subscriber numbers not too long ago. Apple is notoriously secretive about its services data.
It raises a pretty provocative question for you, the listener. When these companies stop reporting the growth metrics that literally made them famous, is it because the metric doesn't matter anymore?
Or is it because the growth has stopped?
Right.
Usually, if the numbers are going up and to the right, executives want to put them on a billboard. They want to shout it from the rooftops. When they hide them, well, silence speaks volumes.
That's the thought to chew on. Are we entering the post-growth era of streaming where companies are effectively hiding the body? When you listen to that earnings call on Thursday, pay attention not just to what they say, but to what they don't say.
The questions they dodge.
Exactly. That silence might be the loudest thing in the room.
I'll definitely be listening for it.
That's it for this deep dive. We'll catch you on the next one.